It's stressed out. Today we dipped below 1% on the 10-year Treasury for the first time ever. And so we've got trillions of dollars of negative yielding debt across the globe. And even in the US, if you look at investment grade fixed income today, they're producing negative real yields. So I think it's a challenging market for fixed income. Our firm runs a high conviction, high yield tactical bond strategy. The point of that is to try to expand yields so that you can bring yields into a positive real return environment. But simultaneously, I think investors should have the objective of trying to carve off risk. We've got risk, negative real yields right now, plus risk from rising interest rates in the high yield bond space. You've got proxy risk for equities. So I think it's important to think about alternatives for fixed income and potentially avoid investment grade at the moment. The strategies that we operate attempt to dislocate from economic activity. So the objective is to be out in the early phase of declines before negative momentum builds and big declines play out. So hopefully what they'll produce is some meaningful loss avoidance during an otherwise chaotic marketplace. How are high yields positioned for the coronavirus? Well, unfortunately, the fact that a company is issuing high yields means they've already got potential leverage. They're potentially more vulnerable to a decline in the economy. So what one typically sees is as equities move lower, if we enter into some kind of a recession, there's a lot of pressure on high yield bonds, and so people can expect losses in the high yield bond category. So I think the important thing is to try to position yourself, potentially to try to gather high yields, but position yourself to anticipate that kind of dislocation. Equities valuations are stretched, plus investment grade bonds are producing negative real yields. So we believe it's time to think about alternative strategies to conventional investing. So we'd say position yourselves to do two things potentially. Attempt to participate if the market continues to move higher as it has for most of the last 10 years, but also anticipate potentially severe dislocation in the markets. The way you do that, or step number one, position about 50% of an equity portfolio in high beta, low cost strategies so that you'll be there if markets stretch higher. Number two, take about 50% of your portfolio, your equities portfolios, and put it into something that's either unconstrained tactical or hedged equities investing so that if you do see drawdowns, you can potentially lessen that with that other part of your equities portfolio. And then third, as I was mentioning earlier, eschew investment grade bonds at the moment. Look for fixed income alternatives, such as tactical high yield, unconstrained bonds, or just otherwise all alternative fixed income approaches.